Well, good evening, Maverick traders. Welcome out to your trading room as we prep for the week ahead, March 2nd through the 6th. We've got a lot of ground to cover. Obviously, last week was abnormal, unlike any other that we've experienced in a very long time. If you traded, so I've traded for just about 20 years now, and I've only experienced that type of scenario really. Even the bubble bursting, the technology bubble bursting. You had some times like this, but it's most reminiscent of that 2008 decline where it was just cascading lower. And there's still certainly that risk. If you were listening to my Tuesday market roundup, even before the worst of it really hit, you probably thought, wow, he is super pessimistic. I talked about how, from here, there's a very good chance, a very real chance that we could really see a lot of decline and kind of a crash and so on. And that probably sounded like chaos and blasphemy on Tuesday. But that's kind of how this market played out. And so the market will give you some warning signs. It'll show you that statistics kind of go out the window because you can't really play based on statistics and on the norms or anything like that in this type of market environment. It's just very different. I mean, when you get forced liquidations and margin calls and all that happen at brokerage firms, it's not going to trade normal. It's not going to follow any typical script or anything like that. So you kind of have to throw that out the window a little bit and say, okay, I've got to be careful. I've got to be cautious. I've got to make sure I've got limited risk. How much risk am I taking overnight? And just have reasonable expectations and perspective on these things. And as you gain more experience, you kind of learn, okay, what's a normal environment, which is what we deal with 99% of the time, and what's an abnormal environment. And of course, when it goes to abnormal, you can't expect all of those, statistical patterns and things to play out because they're just not going to do that. So, as we jump in here, just a quick reminder, it's very important that as a trader, you follow your plan. If you start to deviate from that plan, especially when markets go haywire, it can get you into a lot of trouble. All of a sudden going against your norms and your risk management and all of those things just because you see and hope that something might happen is a poor way to do it. So stick with the plan. You've built that plan for a reason. Follow through on that. We want to remind you that we're going to have our Chicago Summit, and we're really excited about this. It's at the CBOE, and I've been there a few different times for summits, and it's just a lot of fun. It's a great learning environment. They've got a great setup, kind of that stadium type seating where it's different levels, and you've got all the teaching tools and things there. And then we'll actually take our traders down on the floor, and you'll get to see the open outcry markets and learn more about the SPX pit and the VIX pit. The VIX definitely came into play this week. We saw one of those spikes up above 40, which are very rare. If you go back over the past 20 years, we've probably only had maybe 5 or 6 times, something like that, where the VIX has gone above 40. So a very abnormal circumstance. And we'll actually do some mock trading on the pit. And this is the last time it'll be available. The CBOE is actually moving locations, and the way of the open outcry markets are kind of going away. So this is a great last opportunity to see the floor of the CBOE, see what it's all about, and have that opportunity. So if you can make it, please join us. So as we look at the markets this past week, we had come into the week kind of expecting some downside, but obviously, that was unpredictable. Look at what sectors did. Utilities down 8.7 were the leadership group. Now, let me say that again. The utility sector was down 8.7%, and it was the best performing sector. Energy, obviously the worst at down 17, but everything was just annihilated. And so for the week, you had the Dow, the S&P, the Nasdaq all down more than 10% on the week. A very rare circumstance indeed. Year-to-date performance, that pushes us deeply negative. We didn't have a particularly good January. February turned out much, much worse. And where does that leave us? Well, it leaves us giving back a lot of last year's gains. And last year, and even into this year, when we kind of look at how January ramped up, you got some of that speculative, aggressive euphoria that typically accompanies a market top. And this is one of the things that I emphasized on Tuesday in my market roundup was that we saw behavior that was different. Look at the chart of Tesla, look at the chart of Nvidia, look at the chart even of Apple. Apple's massive, hugest, biggest corporation we have out there at trillions of dollars of market capitalization, and they basically doubled last year. That's an abnormal circumstance. And when you see those charts going vertical, that should a little bit kind of say, okay, the risk taking is getting out of control when Tesla is able to go from $200 per share up to 1,000 in kind of a straight line. And everybody's just kind of jumping on board and saying, hey, it's great. You can't go wrong. Just keep buying. What happens is that risk taking gets abnormally out of control and kind of bubbles over with euphoria. We saw that in 2000 in that tech bubble, which was my first experience with a bubble and with trading a bear market. And the technology market was that same way, where it just bubbled over with euphoria and everybody tried to get involved in it. And it was kind of that bad circumstance where couldn't sustain those higher prices. We saw that in the real estate bubble, and that's what created the 08, 09 Great Recession and so forth. And this one, I don't think is, in terms of a bubble, it doesn't have that same, it wasn't, necessarily market wide, but it definitely had those kind of finishing touches of a euphoria that probably led to some of this. It shouldn't have been as high as it was from last year. And so there was just this little air pocket underneath the market, and it made it very easy for it to fall and give that back. Those gains are now trapped. Those buyers are now trapped with bad positions. And I don't think, I said on Tuesday, even before most of the declines, that I thought the high was in for the market for the year. And again, people probably thought that I was speaking crazy and way too bearish, but that's kind of this environment. I think the top is in for the year. We're going to trade below that for a while. Now there will be some nice rallies mixed in, but that's probably the environment we're in, and we'll talk more about that. So all three major markets experienced just this massive sell-off. The VIX went from 18 to 49.50 in 5 days, closed above 40 for the week. Looking at those long-term charts, you'll only see a few of those circumstances. Now, there is a saying amongst the long-term investing community, the old buy when others are fearful and sell when others are greedy. That's advice that's kind of long-term advice. It's not a great trading term, because if you just go out there and buy whenever something's bad, you're probably they're going to get worse in the short term. And if you try to short something that's good, it's probably going to hurt you, right? As a short-term trader, you just can't time that really well. You want to stick with trends and momentum, and you want to have those factors on your side for the most part. But as a long-term investor, obviously, buying into that euphoria, if you wanted to add to your IRA or something like that and buy some stock, well, VIX above 40 is a long-term, typically a good place to buy something with a long-term perspective. But we're, as a group of traders, we're looking at trading opportunities. The VIX went above 40, and if you'd have bought it, you'd have been down about probably 5 to 10% on anything you bought last week as the VIX went above 40 and kept skyrocketing. So again, not a short-term signal by any means. Now, have we gone from euphoria to panic? Is the panic maybe getting overdone? Absolutely. And I mentioned on Tuesday in the market roundup that there was probably going to be a big exclamation point, a big kind of capitulation, as they call it, where people threw in the towel. And we've definitely seen a little bit of that coming in as well. The volumes have ramped up. Does that mean we've hit the low and that it's all better from here? Probably not, actually, but we're probably, a whole lot closer, just given how dramatic it was and how you saw that volume ramp. So the charts are going to do a better job of explaining that here in a minute. And Darren and I are both here tonight, and we'll kind of go through those with you. So market action was a correction. in search of a reason. You could put a reason around this, and definitely coronavirus is a factor. Politics is a factor. There's a lot of different things. Now, if you're looking at coronavirus, this is probably the lead candidate for, some of that fear and panic. We're definitely seeing that just in consumer behavior. I think looking at statistics, for example, they said something like 20% of people have changed a flight because of coronavirus. And, there were different locations that were selling out of bottled water and all this stuff because people are stocking up. So it's a very real concern. I mean, there's no doubt about that. It's a true risk to the market. It's changing consumer behavior. Are theme parks like Disneyland, those sorts of things, going to take a hit? Absolutely. And you're seeing that in the stocks. At a certain level, though, you have to go, okay, well, how many billions of dollars did the company lose? And what real lasting effect is this going to have? I don't think this is one that just blows over super quickly, but there is a shelf life to some of these panics. And the news does a great job of fueling that panic and that concern and that worry. They know how to push your buttons. They know how to get you to your peak of despair and panic and feeling like, oh, this is terrible. It's all going to keep getting worse and worse. And they're good at that, right? But it has a shelf life in that people will, at a certain point in time, just start to kind of lose. It won't have the same effect, right? So when it's fresh and a lot is unknown, there's more fear regarding that. Knowledge takes fear away. And so as we gain more knowledge and as more is known about this, the levels of fear go down. And frankly, the news just can't keep selling that hype and that fear quite as much. And so it will start to dissipate a little bit. And you're going to see that probably not this week. It's still going to be on every time you turn on the television, it's going to be talking about coronavirus somewhere and new statistics and new death rates and all of these sorts of things. But my guess is that about a month or two from now, you're going to see that it's just not going to have the same effect. People are going to get a little bit more comfortable and will just not have as much fear and panic regarding that. And before the market kind of bottoms out, what oftentimes happens is a little bit of a divergence where the VIX will actually have topped out first. And I wonder personally if the VIX has put in its top. So the VIX had this huge spike up to basically 50. My question is, has the VIX topped out? And what it would do oftentimes is kind of put in a lower high. But markets oftentimes put in a lower low. So in other words, the VIX, my trade guess here, and it's really kind of a guess, but what normally happens in these circumstances is, again, we probably saw kind of almost the peak of fear this weekend, the end of last week, and so on. So it wouldn't surprise me if we've seen the VIX actually hit its peak, hit its top. The only way you're going to go back and just keep going through that and through that and through that is really if things just keep getting worse. I mean, if all hell breaks loose, well, then the VIX can go higher. In 2008, we saw the VIX get all the way up to 90. Now, that was such an extreme circumstance. I don't know that I'll ever see that again in my lifetime, and I don't think it's happening now. I'll be on record with that one. Actually, what normally happens in these circumstances is the VIX probably hit its high. It will kind of, things will calm down a little bit. You'll have another big scare, but it won't put in a new high. It will kind of top out. At the same time, though, stocks will make a lower low. So we'll have our low in stocks. They'll kind of bounce, and that's where that VIX would have its first decline, is when stocks decide to bounce. But then stocks will actually go lower and make a lower low. It's just that the VIX will put in a lower high here. So notice the difference. Stocks at a new low, VIX at a lower high. And that's a normal circumstance because stocks are still in a downward trend. They're still having selling pressure and supply hitting the marketplace. but fear could have already hit its peak and already kind of topped out at those levels. So watch for that little divergence where, again, I think that's the norm and that's probably what's going to happen. If instead the VIX made a lower low and then all of a sudden exploded to a new high, then something has gone terribly wrong. And this will be your first big clue that, okay, so, another something else, another shoe has dropped, as they say. So I don't expect that, but I would expect that stocks will make at least a temporary kind of a push to new lows following the first bounce. I don't think we've hit the market lows. That would be abnormal. Go back to 0809. And what happened in 0809 was actually the VIX hit 90 in 08. Remember, it didn't bottom until March of 2009. So the VIX kept trending lower and lower, and the market was going lower as well. And then the market finally kind of bottomed out, and we went higher from there. Economics have definitely gotten weaker. China just came out with a number before we jumped on here, and it was as terrible as their numbers last week. The numbers are really getting bad. Their number that they came out with tonight missed expectations. It was expected to come in. The PMI was expected at 46, and it came in at 40. And we're just seeing that. And so the China numbers are going to be worse because it's already been an ongoing issue. They have the tariffs, number one, but now they've got this coronavirus and people aren't going to work. They've shut down factories. They've shut down a lot of things, and they're even seeing that in terms of the pollution. The pollution has gotten a lot better in China because, again, a lot of this stuff, manufacturing-wise, has just slowed down. So that's going to be the first place you see the economics because, again, economic numbers are lagging, right? We'll report a number from the prior month and so forth, but China's had enough of an ongoing, this coronavirus isn't brand new. They've been had issues and slowdowns and whatnot for multiple weeks. It just kind of reached its peak of worry last week. So China is going to be the first one to have a slowdown, and then U.S. and everywhere else will probably have a little bit of a lag, but I'd expect next month's numbers to start taking a hit from what's going to start to happen here in terms of slowdowns. Liquidity issues can be a concern. Bond yields showing that there's panic. I think the 10-year just broke below 1% for the first time ever. That these are extreme low yields. We've got negative interest rates in some locations around the world, but a crazy environment, of course. Economic reports wise, jobless claims slightly higher than expected. You don't want that. We want people to have jobs, and when they're claiming to be jobless and that number's rising, not good. GDP for the fourth quarter was flat from the prior, and Chicago PMIs came in just under 50, which shows a little bit of a contraction, a little bit of a slowdown that way. So as we look at our closed positions, given the negative market environment, we actually had some really good stuff going on here in terms of our trading. You can see very nice positions in terms of UPS and Trip and Cisco and on across the board. Had a couple of call butterflies that didn't come in. Shorter term trades that were looking for a zone, but otherwise, as would be expected, these long puts and short stock positions were the way to go, and they were very successful last week. As we look at our open positions, well, bearish positions hitting expirations and even got a little more bullish towards the end of the week as traders looked on Friday to add some exposure to the bounce. And this probably really makes sense in terms of that kind of capitulatory, maybe a little bit of a potential for a bounce. And if you're looking at the futures markets after hours right now, what's interesting is, so as we look at the week ahead, as people were coming into this weekend, there was a hope for Fed stimulus and a hope that maybe the Fed would step in there and announce a surprise rate cut and so forth. And that didn't happen this weekend. And so I thought, well, futures are going to be down as they open, and they were. I think we gapped down, 20, 25 S&P points or whatnot, but they've come rallying back, and the futures are actually up 10, 11 points right now from a really bad start to where we started. So we're already starting to see some of that buying coming in, as we saw on Friday towards the end of the day. So a little bounce here, very likely. I think you potentially could have a better bounce later in the week. It's going to be a little choppy. Darren will talk a little bit more about that. But one of our traders getting a little more aggressive there towards the end of the week in terms of that bounce expectation. So if we look at that chart, here's the TQQQ, an aggressive levered ETF going long, and I don't remember exactly where they bought, but somewhere in there, which actually started to participate and already has a nice little profit from where they entered. And everything should be looked at. I think this is the way to trade it. The way to trade this market is to say, I'm going to put on a trade. If you want to trade, for a bounce, put on a trade that says, here's my limited risk, here's my limited reward, I'm following my plan. If you had done that, then this sell-off wasn't so painful, even if you had a couple of losses in there. If, however, you just said, I'm going to step out in front of this speeding bus and I'm going to throw it all on the line, hoping for a bounce, well, that doesn't make sense in any market environment, because eventually what goes wrong can go, what will go wrong, and that's what we saw this week. So if you have some limited risk, which is what this has, limited risk, limited reward, playing it for a bounce, I don't think this trader will be in this trade that long. It's not mine, but I don't think they'll be in it for that long. They're not playing this to go to new highs. They're playing this for the bounce, and as they hit their targets and so on, they'll look to take some profit. So let's go through some market analysis, and I'm going to turn the time over to Darren here in a little bit. But looking at market analysis, I think it's fair to say that everything looks horrendous, and that's probably the theme here. So I'll just start with the Dow chart, and then we'll have Darren take you through a couple more. So here's the breakdown in the Dow. All week. I mean, it started on Monday. You can see the gap lower. That gap lower took out support. That gap lower on the attempted rally failed and left the long upper shadow. That gap lower is a breakaway gap, meaning it didn't fill the gap. It didn't even have enough strength to come up here and try and fill the gap. It didn't even attempt it. It just broke away and kept going. Here's Tuesday, where I talked in the market roundup about that potential for just this thing to cascade lower. And Wednesday, Thursday, and into Friday, that's exactly what it did. And now we find ourselves with a little bit of green here on Friday. But what's going to happen from here? Again, you'll probably see some form of a bounce. And I don't even know if it'll be that large, but some form of a bounce, and then probably at least a temporary new low, where I think the VIX has topped out and fear kind of reached its boiling point. That doesn't mean stocks have bottomed. Stocks will usually not hold that first initial flush out. They'll go down there and test it again. They'll try to trigger some stops and flush some people out there again. So on the rally, which can be pretty steep, I mean, when you fall in a straight line like this, you can bounce pretty hard, but it's going to be quick. And I think you've got to shorten up your time horizons. You have to think about both price and time. Back here, you had to be holding your bullish trades. I mean, how long did you have to hold them to hit your targets? Well, I don't know, a week, 2 weeks, 3 weeks. It depends on your form of trading, but a while. Here, if you bought at 250 seeing the recovery, you might get a move to 257 to fill this gap within a day or two, right? Which can be equally, I mean, that jump there is every bit as strong as this 2-week rally here. It's the same price move. It's just happening much, much quicker and in a shorter time period. So think about it in those terms, and think about it in percentages. Don't get stuck on time horizons. You're going to see some 5, 6, 7% rallies. They're going to happen within a day or two, and then they're going to fade off in all likelihood. So if you're going to be bullish, consider the length of time that you're going to be in, because it's probably not needing to be that long, and your time horizon doesn't have to be super extended. So Darren, take us through a few more of these with your thoughts.
Yeah, thanks a lot, Corey. That was a really good synopsis right there. Let's go take a look at we can see the diamonds right here. What bothers me, and now we're looking at the spiders right here. What bothers me about these is that you see what looks like the price action, possibly the volume for for capitulation right there. But we're going to see a 5-minute chart. That's not really the story. I mean, we couldn't even get back, we couldn't even hold above the low of Thursday's low. We still closed down. We did not gain anything on there right now. This is that 5-minute chart that I was talking about. And this is what was really interesting. I mean, we see the open. We gap down at the open, and then we had some more weakness right there. And you get a gap down like this, and you see 2 up candles. You think, okay, maybe this is it. Maybe this is the place to go. And I actually got into a trade, and I got knocked out of it very, very quickly because we went down and hit new lows. Down to 286. I was talking to another trader a few days ago that wanted to keep some long positions, and I said, look, if you go back to Q4 of 18, you had a 50-point drop. This could very well be another 50-point drop from nearly 340 down to 290. You could see on the S&P, we got down to 286. About 11:30, we tried to poke up. We couldn't hold that period, and we were just in this range between about 288 and 294 for the rest of the day. It was only the last 15 minutes of trading. Corey, if you want to highlight those last 3 candles, those last 15 minutes of trading, that we actually made our gains. Okay, the rest of the time, the volume was a little bit elevated, not so much, but you can see the volume on those last 3 candles wasn't particularly great. So this this makes me wonder. I mean, this looks like textbook capitulation. I mean, we gap down, we have an up day, but the story's not really told. If we'd have closed an hour early, I mean, this would have just been a doji. But that last 15 minutes is the only thing that gave us a green candle for the day, and that doesn't. And if you look at the volume, up volume versus down volume, this is some very, very anemic price action right here. The Nasdaq held out the best, and actually, it came up there and got the closest. I think, we go to the chart of the Nasdaq, and you're going to see we, gained a whopping 0.16 points on the Qs. This is the only one that was able to show a gain, and it wasn't even $1 worth of gain. So the Nasdaq is actually looking the best here, but this is one of those things where price action is going to trump everything. But if you take a look at the inner picture, this may not be capitulation right here. So we're going to go through check this week's events. Capitulation, we may or may not be here. I'm not going to stick my neck out and say that this is it or this is not it. We want to look for a pivot point, and we want to make sure that we're seeing higher highs and higher lows, and a significant drop in that VIX before we decide to start going long. Those trades in the TQQs and Gush, GUSH, that's a knee-jerk, not a knee-jerk trade. We're playing specifically a bounce on those 2 trades. We've got about a 3 time horizon, but I can guarantee this: if we see some meaningful movement in those options, in TQQ and Gush, we're going to scalp out of those positions. That is not one that we really intend to hold very long. We put down markets are in a euphoric state. Okay, euphoric is probably, I would say, dazed and confused might be a little bit better way to put it. Good news, you could have a massive bounce. Bad news can add to more losses, and this is extremely headline driven. I mean, you take a look at our outlook last week was -1. We didn't think we were going to get a -10, and the only thing that cued us into that -1 was Thursday's action and Friday's action of the week prior. And so luckily we had gotten our portfolios a little bit bearish, not as bearish as obviously we wanted. But that first day, Monday's open, really started putting a lot of pressure, and you could see it specifically on Tuesday. And Corey's very good at seeing this. If you go back and take a look at Tuesday's chart, you can begin to see about 2:30 Eastern a lot of margin calls. People were not adding to their positions; they were selling positions to free up cash because they were some of them were just taken out. So you can really see. Yeah, that's why we put down this was a correction in search of a reason that really got out of hand very, very quickly. Economic reports, we can basically ignore all these. Market action is going to be the only thing that we're taking a look at. Manufacturing PMI, ISM in manufacturing on Monday, employment, factory orders. We need institutions to come in and say, okay, just the prices look attractive at this point. We're willing to put some capital behind it. They're not even going to be looking at. They're going to be looking at price action. They're all going to be looking at each other saying, okay, who's going to be first? If nobody wants to stick that toe in the water, we're going to go down. If you get a couple of brave souls that are running multi-billion-dollar portfolios, they're going to start putting buy orders out there, then expect to see the buying accelerate very quickly. That's where we get our bounce. Where it goes from there, we're not looking out more than 2 or 3 days, honestly, to see this. So let's move on. Our monthly bias right now has changed. If you talked to us 2 weeks ago, we had a +1 for the month. Now, just technically, the only thing we can say is a -2. There's been a lot of technical damage done. So this week our outlook is going to be something and then a +3. And what we mean by that is we may start to see that bounce on Monday. We may see continued selling. This action of the futures. People that are still in a hurting position might take the advantage of that bounce, sell into that bounce in the futures, and they're going to drive prices right back down. The thing is, we don't know, and that's fine. That is completely fine. We're going to wait and see. Price action is going to determine what we do. We do, however, expect a rip your face off bounce coming, just as people who did get short are going to begin to liquidate those positions and start booking some profits. Sector analysis, we're going to be able to go through this very, very quickly. Hit utilities, and we update these charts right there about on every quarterly basis. Technically, right here, even though utilities held in the best, we're at a -3. I mean, this is to the point. This is one of those periods of the markets where everything is just so hurt. I mean, I can go back through and say everything here is technically a -3, but you see that long lower shadow on utilities. It held up the best. This one could get a bounce, especially as people maybe think they want to get more defensive right now. Same thing in telecom. Telecom actually had a pretty decent day on Friday, but still the damage has been done. I mean, it's -3. We can just keep going through these, very, very quickly. Everything here, again, real estate, nice long lower shadow, but with massive damage done. I mean, we're way below support. We're out there. We got to go back into early 2019. Industrial, same thing. We're looking out here. Healthcare. Every one of these charts is going to look the same.
Yeah, and these correlations, Darren, when markets go down like this, the correlation goes to 1, meaning every market, every stock out there. I mean, we had 99% down days for multiple days in a row, which tells you it's just indiscriminate selling. And it's another thing that shows you that there's forced liquidations and all that stuff happening because it doesn't matter what you own. They're selling it all. They're selling gold. Gold theoretically should have gone up, and yet it was being sold off just like everything else. So like your point, everything just looks the same. I mean, is there any difference to this chart than any others? Financials, I mean, maybe one underperformed another, but they're all very similar. So
yeah, good point. Very good point, Corey. When people are looking for cash, they're going to sell anything and everything they can just to get into cash. Tech actually held up decently. I mean, held up decently, but at least you could see it made some gains. It was up 0.75% on Friday. That's one of the best performers right there as well. I mean, you keep looking. Materials, ugly chart. I mean, we were going back and forth on materials several weeks ago about this just is not a place to trade. We're well below that support. I mean, we're below support that got put in initially in November and then tested again in February. We're back below October support. I mean, so that's how much technical damage has been done. And here's energy, the worst performing sector out there right now. Uh, One of the few times that we're actually going to look for counter trend trades, just playing on that slingshot bounce. And here's where we have to see is the bounce that we're going to get. We know we're going to get one. Is it going to be a dead cat bounce, or is there actually going to be some strength in this market? This is where the fundamentals you need to trade technically, but keep an eye on the fundamentals in the back of your mind. Where this comes in with coronavirus in China, it could be a supply chain disruption more than anything else. I don't think anyone is truly looking at this. The mortality rate, among the coronavirus is, about the same as what it is for the flu. What people are worried about, though, is it is incredibly transmittable. Very, very virulent strain, goes from, for a lot of people. I mean, you see internal flights, are getting canceled in China. There's just not people moving around. U.S., we're more worried about the supply chain disruption and where it goes from there than we are anything else, is what it seems. But I mean, you see, first day we just took it out. So the only way to rank these sectors right now is urgent care, intensive care, and life support. In that urgent care, they're bleeding fairly well, might need some stitches. Utilities, telecom, and tech. Those are the ones that are looking good. These are probably going to be the ones that bounce back the fastest. What's in intensive care right now? Real estate, financials, healthcare, and consumer. These are probably going to bounce back a little less and a little later. But that's what we're looking at. What's on life support right now? Industrials, energy, materials. I mean, this stuff. I mean, they've got the ventilator on them. They've got pacemakers put in. These things are looking really well. Nobody wants to know. Nobody wants to know these right now. If you said you're in the energy sector, people are going to walk away from you. They don't want anything to do with you right now. So that's what we're looking right now. So if you're, it's very, very difficult to get short much of anything. But if you were to get short of something, industrials, energy, materials are probably going to have the least amount of bounce and take the longest to do it as well. Let's continue on here. So potential trades, utilities right now, nothing. There's nothing that looks good for us. Telecom, healthcare, right now, nothing. This is a time, BioMarin. This did look good in healthcare. You can see as much as the damage was done, BioMarin only went down and touched its 50. I mean, this is a rock star right now. The uptrend is still intact in BioMarin. So if you're looking for a bull in healthcare, this is one that's going to be good. Only dropped 5 points in 5 days, the 5% when everything else is down multiple digits. This is looking good. Something like this, it has the potential to be very volatile right now. I mean, you could look at those 85 calls, size them for max loss, size them so that if the whole position goes to zero, it doesn't impact your portfolio. Probably what a lot of other people are going to be looking at, that 90-95 bull call spread right there. I think is probably going to be your best trade to look at. For industrials, nothing. Financials, Green Dot Corporation. This is where your screening really comes in to help. This is not a name that we ever considered trading before. It just didn't hit everything. But this is the same kind of chart that BioMarin had. As far as the financial right now, we only pulled back to the 20-day moving average. From about 37 to 34, right there. That's all. I mean, this is looking pretty good. I don't care what these people do. I mean, they could be providing banking services for illegal enterprises. I don't care. The market take a look at this and said these guys are worth holding in. I mean, we've gone back and you see that it gapped up and then fell back down back there in November. But that appears to be support at this point right now. So if you're looking for something bullish, I would say go ahead and take a flyer at that one. Again, size everything for max loss. If you're going to go do those 30 calls, you size them so that if you go to zero, it's not going to be anything. But a 35, 40 bull call might be a little aggressive, but that's the strikes that they've got. I would be happy to go with a 35, 40 bull call. For consumer, nothing. Tech, we actually found something. Again, another name that we don't see a whole lot. This is actually up for the week. Monday, Tuesday, Wednesday, we had a nice orderly pullback to the 20, a green day on Thursday, and Friday we're back at the previous highs. Whatever the Zayo Holdings group does, and who cares what they do. You ask me, my portfolio, what do these people do? Half the time I tell you I don't know and I don't care. That's the same thing right here. You're only looking for the stuff that survives. This is the stuff that is going to be going good. Again, size it for max loss, but these are very, with all the market action, these are very, very strong stocks right here that are probably the probabilities for them to rise first and fast are out there. When we get our uh, our 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 bounce. Excuse me. And materials, nothing. Energy, nothing. That's the only places that we found this week. If you're looking at stuff, and on the long side, you've found other trades that have held up nicely. Go ahead and put them in, log in, and go to the forum, put them on the trader trades, and go ahead and add to this week. It really does help to have everyone looking at the market. Right now, I mean, if you take a look at our portfolio, like we said, we are weighted to the bullish side. There's no doubt about it. Those trades were sized for max loss. We're going to see where they go, where they end up. We're probably going to take a look at a few things to see what has continued weakness and try to realign our portfolio more towards a zero for the foreseeable future. And this is a wait and see market. We're going to get a bounce. We just don't know when it's going to happen. And we're going to be prepared for it. We're traders. We can be in, we can be out. Let the market action tell us how we should run our portfolios. So in conclusion, major technical damage is done. The outlook long term is really uncertain. Don't try to catch that falling knife. Okay, the market still has a lot. It could still have a lot of weakness in there. Wait to make sure that we've got a confirmation that we're going to get that bounce. And remember, don't get too short, because that rebound can smack you in the face right on the way up. So be very, very discriminating about what you're putting in your portfolio. Make sure it's filling the exact spot that you want it to fill. Look at relative strength and weakness. What's held up? What's been the worst? And sometimes you might just need to sit on your hands and wait till something develops a tradable chart pattern before you do it. Corey, I mean, you've had, as you said, you've had about 20 years experience doing this. I mean, what's your personal outlook on how willing you would be to add positions to your personal portfolio?
Yeah, and I don't mind adding positions, but it's really a risk to reward game. And a lot of times in this type of environment, I talk a lot about the psychology of markets because it really has an effect. And what will happen here is you'll get kind of maybe this interest in buying the dip that's so aggressive that it has to run those people over. And that's kind of what we did last week. And now we have to ask ourselves, okay, are we kind of reaching the end point of that? It definitely looks like an area where there should be a short-term bounce. However, that short-term bounce probably, once you want to buy it, here's kind of the way I look at this is if the market gives you the perfect time to buy or the perfect time to sell, then it's probably not the right one in this environment. And so I would kind of look at it in terms of, when you get those bounces and you start to think, oh, I'm missing it, I've got to get in. That's probably the end of the bounce, if that makes sense. And so you've got to kind of be a little bit careful about how you enter these trades and how you go about managing them because if you wait until it looks like we're really making some ground back to the upside. I mean, we've come in a straight line down, so the chart just kind of looks like this. Well, if you say, well, I'm just going to wait until things look a lot better, and so you've rallied for, 3, 4, 5 days, and you're like, oh, now we've got this really good momentum. Well, essentially, what you've done is you've put yourself in chase mode because you're like, oh, it's rebounded, it's going back up without me, which is essentially the place you want to be selling. It's kind of counterintuitive in these markets, but if you're going to be a buyer, that all of them are in downtrends. All of them have massive capitulatory, cascading prices to the downside. So you're not buying any uptrends. Make no mistake, nothing's in an uptrend except for a few different chart exceptions, right? So if you're buying a sector or something, you're buying into weakness essentially. You can find some charts that look better, no doubt, and that's a good place to start. But what I would emphasize is you've got to look at this from the standpoint of risk to reward. And you've got to say, okay, Friday we put in a low. If I get my bounce here for a couple of days this week, I don't want to be entering trades up here because that's probably a bad spot to do it. So I would look at some of these things and say, okay, maybe I can go, and we gave you a few different charts that are still in uptrends. Maybe I can look at buying them because they're on a buy setup and everything else looks like trash. Their sector looks like trash. The market looks like trash. But if we get that bounce, I'm not going to stay too long. I'm not going to overstay my welcome. If the market is on a big road to recovery and if we've truly bottomed out, then it will still have to work its way out of this over time. It will still give you some of these pullbacks and that make a higher low, which is a better risk to reward entry than chasing these big upside moves. So when I look at it, I kind of say, do I want to be the one that's finally buying the rebound rally, the counter trend trade, 4 or 5 days after? Probably not, because at that point the recovery has played out. This is reminiscent a little bit of that 2008 2009 time frame, because it's the only time in recent history. I realize it was over a decade ago, but it's the only time in fairly recent history where we've had a 10% downside move in this short period of time. And so if we're doing a comparison, if you are buying into those rallies, we had days where the Dow was up 5%, 6%, 7% on the day in 2008. And those were the worst spots to buy because it had already made its run. And that's what I guess I'm trying to emphasize is you almost have to look at these capitulations, turn to your hourly charts, turn to your 4-hour charts, and use those uh, turning of trends, because you're not going to get any trend changes in the dailies. Just make no mistake. Those trends are not going to turn for a very, very long time into uptrends. We're going to be persistently in downtrends. So you got to try to buy reversals quickly and not overstay your welcome. Hope that makes sense.
Yeah,
Um,
thanks, Corey. Yeah, this week's class, do you have something else you wanted to add?
No, I was just going to say, in terms of classes, we have that Market Foundations on Tuesday. So come and join us if you can. And if there's anything that we can do, I mean, from the risk side, if you want to, a second set of eyes or some feedback or anything like that, reach out to us. We understand that sometimes times like this are stressful, especially for a new trader. So just make sure if you have any doubt about position sizing or anything like that, you're managing your own book, and that's what we want you to do, and we trust in your trading plans and things that way. But if you want some feedback and whatnot, we're happy to help that way as well.
Absolutely. Absolutely. And if you take a look at the interesting thing that one of our traders pointed out is if you take a look at a monthly chart and look at the 20-month moving average, we're right down there, right at it. I mean, February was an ugly month, but we're still right at long-term support on a monthly chart. So that's something else to consider in there. Uh, anyway, thanks everyone for attending. We're here to support you. Remember that. Be selective about what you get into. And as Corey said, I mean, you don't want to wait too long. These are going to be quick trades, 3-4 day trades. Probably wouldn't want to go out more than a week unless you're really, you're playing for that, playing for something longer term.
Thanks, everyone. We'll see you
Thanks,
next
everyone.
time. Goodbye.
Have a great day. Good trading.